On Wednesday, all eyes will be on the Federal Reserve. Expect a rebound, especially if the Fed maintains its cautious tone in this week's FOMC meeting. The most sensitive point of the first value gap that we can see here is located at 101.585. Welcome everyone, my name is Isaac Martinez. I'm a trader and market analyst at xChief. In today's weekly outlook, we'll take a closer look at the financial markets. Combining key fundamental updates with technical analysis, we will analyze the US dollar index, SP 500, Euro USD, and Bitcoin to help you navigate market volatility and upcoming trading opportunities. Make sure to stay with me until the end as we will cover the most important zones to watch this week. We will start as always with the economic calendar. Don't forget that the hours we are going to see are based on GMT-5, the New York trading session. This week we have several key events that traders and investors should watch closely. On Monday at 9 a.m., we will get the ISM Services PMI. This report tells us how the service sector is performing, which is important because it makes up a large part of the US economy. A strong number can be good news for the dollar and stocks, while a weak number might create uncertainty. On Wednesday, all eyes will be on the Federal Reserve. At 1 p.m., we'll get the official interest rate decision. This is a major event because it shows us if the Fed plans to raise, lower, or keep rates unchanged. Right after that, the FOMC statement will be released, which gives more details on how the Fed views the economy, inflation, and the job market. Then at 1:30 p.m., Fed Chair Powell will speak in a press conference. His tone and the words he chooses can move the markets instantly, especially if he hints at what might come next for interest rates. Finally, on Thursday at 7:30 a.m., we will get the unemployment claims report. This shows how many people filed for jobless benefits. If the number is rising, it could be a sign the job market is slowing down, which may influence Fed decisions and overall market sentiment. That's the key economic data for this week. Now let's move on to the fundamentals of the markets. Gold wrapped up another volatile week, falling for the second consecutive time. After starting the week near $3,326, prices dropped to a low of $3,226 before attempting a mild recovery into the weekend. Volatility was driven by mixed signals from economic data, especially better than expected US job numbers and stronger dollar. Sentiment among analysts remained divided. Half of Wall Street expects more downside ahead, while a slim majority of retail traders still see upside potential. Technical pressure and reduced safe haven demand are keeping gold under pressure, especially as optimism grows over potential trade deals. Analysts warn that if this sentiment holds, we could see prices drop to the $3,150 or even $3,000 zone. Others note that a break below key levels could trigger deeper corrections toward $2,900 or $2,700 in the medium term. Despite the recent drop, some analysts still expect a rebound, especially if the Fed maintains its cautious tone in this week's FOMC meeting. Meanwhile, others recommend waiting for clearer signals or using this pullback as a buying opportunity, expecting long-term bullish momentum to resume later in the year. Following Friday's stronger than expected US jobs report, traders have pushed back their expectations for the first Fed rate cut of 2025 from June to July. The probability of a cut in June has dropped from 50.4% to 31.8%, while the odds for July have risen to 57%. Markets are pricing in a 25 basis point cut, which would bring the federal funds rate down from the current 4.25-4.5% range to 4.25%. The April nonfarm payroll report showed 177,000 jobs added, significantly above the 138,000 forecasts. The unemployment rate held steady at 4.2%, while wage growth eased slightly to 0.2%. Revisions to prior months' data subtracted 58,000 jobs. And now we continue with the technical analysis of key financial assets, beginning with the strength of the dollar through the DXY index. First, we need to understand where we are coming from as I always mention, we've established a support level around 97.921 area, and it's likely that from here the price might attempt to rise. Why? Because we are already seeing early indications that the price might break above this area and initiate an upward move. It is crucial for the strength of the dollar to successfully break through the resistance zones at 100.276 with conviction, meaning we need candlesticks bodies to close firmly above this level. If this happens, we could be witnessing a market structural shift from the evidently bearish pattern observed over recent weeks towards a bullish structure where we could see a significant recovery in the dollar. If we manage to maintain this bullish structure, I would set several targets for this week. The first two targets are based on two existing fair value gaps that I've identified. The most sensitive point of the first value gap that we can see here is located at 101.585 and the second one is 102.247. Both potential areas where the price could move upward to try to reach them. Additionally, I would mark the 103.534 level as another probable upside target. And finally, although it is a more distant objective, I'd highlight 104.683 as an area where price recovery could extend. On the other hand, if we remain bearish or maintain bearish projections on the dollar index, I would set clear downside objectives at 98.929 and ultimately target a retest of the recent lowest low at 97.921. Regarding the SP 500, we've observed very interesting movements lately. There are still two pending gaps fills left open that price could target, and we are seeing them here if bearish movements occur this week. However, at this moment, we've already reached several bullish targets, including the latest objective we set over recent weeks at 5,695, as we can see right here, a zone currently being tested by the S&P 500. From here, it's crucial to observe if the price continues moving upward towards the next significant level at 5,786. We can see here the liquidity point that we are referring to. At this point, we should carefully evaluate the possibility of a market manipulation or reversal pattern, and manipulation like this, where we can have a new pullback or a simple reversal pattern, which could signal the start of a correction and offer potentially entry opportunities. Personally, I maintain a bullish bias for the S&P 500. It's key for the index to break convincingly through the 5,786 resistance area, something like this, as only then could we witness a clear market structural shift from bearish, as we can see here, all this bearish pattern, to a bullish pattern like this. And obviously with this correction, the S&P 500 might offer us a good buying opportunity. I would set two clear bullish objectives. The first to confirm a breakout, 5,786, and the second as an upward target if I would only leave one clear bullish objective, and it's to confirm a breakout at the point I told you before, 5,786. On the downside, I've maintained three clear bearish objectives at 5,000, 5,324 and $5,186. As we can see, all of these three targets are related to fair value gaps and their 50%. Changing assets a bit, let's focus on the Euro-USD pair. We clearly see strength from the euro against the dollar. It's evident that the euro does not want to fall. It's resisting any downward movement and maintaining bullish strength. We need to stay alert. We need to stay alert because over the next several hours and indeed days, we might observe developments allowing us to take advantage of a correction. Although the price hasn't yet broken key levels, I would set bearish zones for the Euro-USD starting around 1.12642, maintaining the same downside targets as last week at 1.11453, 1.10875 and 1.10115. 1.1475. Regarding bullish targets, I'd initially looked toward 1.14252 and subsequently 1.15732 if current fundamentals persist. If the context remains unchanged, specifically if the United States and China continue without resolving their tariff conflicts, it's possible the euro might further strengthen against the dollar. Consequently, we might continue projecting an upward move. Thus, these two bullish targets remain valid for this week. Additionally, I'd consider the next upside objective at 1.16921 as a level where the price could realistically reach, especially when considering the daily time frame. Lastly, let's take a look at Bitcoin, one of the assets we also trade. It's crucial for BTC price to have a significant reaction and avoid breaking below the critical $93,000 support area, which we've identified as a major defensive and buying zone. Holding this level prevents large investors, those positioned between 93,000 and 97,000, from entering a state of fear or bearish sentiment, which might lead them to sell heavily, thus triggering a substantial downside move. If we remain within this context, the area around 92,911 becomes a zone that BTC must defend and not break to the downside. However, if the price does break below, the first bearish target I'd highlight would be at $91,685, followed by further targets at $89,698 and ultimately $86,175. Regarding clear bullish objectives, I'd initially set an upward target at $95,000 level, and additionally bullish targets to consider would be $97,383. As we can see, we have a very active week ahead. Much will depend on the statements from the Federal Reserve, which could help drive asset prices in alignment with the projections we've outlined. Thank you for joining us in this week's market analysis. If you found this content helpful, don't forget to give it a like, subscribe to the channel, and activate the notification bell so you never miss an update. And if you haven't yet, I invite you to open your trading account at xChief.com and take your trading to the next level with a trusted broker. See you in the next video.